Welcome to Money Making Minds YouTube channel.
We are embarking on a massive deep dive today. We're exploring one of the most, I think, frustrating and persistent questions in finance.
Richard?
What really separates the people who consistently make money trading, the pros, from the, let's face it, the vast majority who just try their luck and end up losing.
And the fundamental revelation here, the core truth we really need to get out on the table right away, is it's super counterintuitive.
It really is.
When you actually pull back the curtain on what profitable trading looks like day in and day out, the reality is it's kind of boring.
Exactly, kind of boring. The myths, the guys on yachts, the secret indicators that promise these huge returns, the constant adrenaline rush, that's the image they sell to amateurs.
It's great for movies, but terrible for your bank account.
Makes for compelling television, but it fundamentally misunderstands the actual mechanism of how wealth is created in the market.
Okay, let's unpack this with a great story that really sets the stage. There's this anecdote about a meeting with a trader named Marcus. And this wasn't just some guy in his basement.
No, this was a guy managing an 8-figure portfolio.
Right.
So what do you expect when you sit down with a trader of that caliber?
I expect to hear about market timing, geopolitical predictions, maybe some crazy proprietary technical system running on 10 screens.
The secret formula, that's what everyone is looking for, right?
The secret formula. It's that default amateur mindset. You're searching for certainty and for excitement.
But the reality of that meeting with Marcus was the polar opposite. The visitor spent 2 full hours with him just discussing spreadsheets.
Spreadsheets, risk calculations, and checklists.
Can you imagine 2 hours, not on some cryptic chart pattern, but on the mundane, detailed infrastructure of a trading business?
He was showing him his detailed tracking of every single trade metric, calculating his statistical edge down to the 100th%.
And defining exactly what his maximum allowable portfolio drawdown should be in any given quarter. It was all math.
He treated risk management formulas with this reverence, like a Michelin star chef with their best recipe. He talked about position sizing as the single most critical variable.
And the checklist, this rigid, almost monotonous daily pre-market checklist.
So the takeaway from that meeting, and really the core of this whole deep dive, is that professional trading is fundamentally about disciplined execution. It's about relentless self-analysis, repeatable process, and above all, it's just math.
Our goal here isn't to give you a stock pick. It's to close that philosophical gap, right? Between the Hollywood myth of constant excitement and the Marcus-level reality of disciplined process management.
We want to give you, the listener, a realistic roadmap and the mindset shift you need to approach this as a serious business.
Yeah, a real business.
Okay, so let's start with the definition of a professional, because I think most people get this wrong right from the get-go.
They absolutely do.
They assume it's just about scale. Like if you've quit your job to trade full-time, or you've got $1 million in your account, you must be a professional, right?
That is the most persistent myth, and it is entirely flawed. Professionalism is a measure of approach. It has nothing to do with account size.
So you're saying I could be a pro with $50,000?
Look, I know traders operating with under $50,000 who are total pros, discipline, risk management, the whole 9 yards. And on the flip side, there are countless people who, inherited or deposited millions into a brokerage account and trade with the reckless habits of a complete amateur.
So it's not full-time status, it's not account size, it's not even about getting fancy returns, it's about the characteristics of the trader?
It's all about the approach.
So what are those core non-negotiable traits then? What defines that professional approach?
We can really boil it down to 4 pillars. First, and this is the most important one, they manage risk with surgical, mathematical precision. They don't guess.
No gut feelings.
0. They know exactly how much they are risking in terms of their total portfolio, and they never, ever violate that parameter. They can tell you their max expected drawdown before they even click the buy button.
They treat that risk tolerance like a sacred wall they can't cross.
Absolutely. Second, they treat trading as a business. And this goes way beyond just, keeping records for taxes.
Right. It's about having a business plan.
It means detailed record keeping, systematic performance analysis, a focus on process improvement, and keeping enough capital in reserve. They have a CEO mindset, constantly reviewing the efficiency of their own operation.
And what happens when that operation hits some turbulence? A bad month, a bad quarter?
That leads to the 3rd pillar. The ability to execute their strategy with cold, unwavering discipline, especially when it is profoundly uncomfortable.
Which is usually during a losing streak.
Oh, always. Or even when fear creeps in after a few big wins. The amateur improvises, right. The professional just executes the plan, period.
And the fourth pillar. This one feels like it governs the other three. They prioritize consistency over individual wins.
100%. They are not hunting for the next 10-bagger or the big short squeeze. They are focused entirely on executing their statistical edge over and over and over again. They know that the law of large numbers will deliver the profits over time.
And notice what wasn't in that list.
Exactly. None of those 4 points mentioned a specific return percentage or secret market knowledge. It is all about structure, process, and self-control.
That sets up the most crucial mindset shift then. Moving from an outcome focus to a process focus. As an amateur, I see a stock chart and I see an opportunity to make money.
Of course.
And I judge my success by whether I won or lost that one specific trade.
And that is a huge psychological trap. The professional view recognizes a brutal truth, and that is you have statistically zero control over the outcome of any single trade.
Zero.
The market can do anything at any moment. You can have a perfect entry, perfect stop, a setup with a 90% probability, and still lose because some unpredictable news hits the wire.
It's the poker player analogy. It's so powerful.
It's perfect, isn't it? A pro poker player can't control the flop, the turn, or the river. That's out of their hands.
Their skill is entirely in controlling their reaction to those cards. Their betting, their sizing, when they fold, their discipline.
It's the perfect parallel. A great process will make you profitable over 1,000 hands or 1,000 trades. But any single hand or any single trade is basically random.
So what you're saying is, if I followed my proven, tested process perfectly, perfect entry, correct size, my stop was predefined, it was a good trade, even if it lost money.
Yes, that's a good trade.
And on the flip side, let's say I broke my rules. I risked 5% instead of 1% because I was so sure, and I won.
That was a bad trade.
Even though I made money. That's a massive concept to wrap your head around. Why is that winning trade a bad trade?
Because you just reinforced a terrible habit. That win created this strong, positive feedback loop in your brain, linking rule breaking with financial reward.
So the next time I feel that sure thing feeling,
You're going to do it again. And that guarantees that when you inevitably hit a losing streak, and they always come, you will break the rules on a large scale, trusting that bad process, and you will blow up your account. That's outcome bias, just destroying your long-term chances.
so my success has to be judged by sticking to the process I can control, not the random outcome I can't.
That's the whole ballgame.
Which means trading has to be about probability, not prediction.
Yeah.
Amateurs are always looking for certainty. This stock has to go up. I know the Fed is going to do X.
And professionals live in a state of acknowledged uncertainty. They think in probabilities they can actually quantify this setup based on my data works 65% of the time, or I have a 60% chance of making 2 to 1 here, so I'll risk 1% and find out.
Let's go deeper on that. Let's use the weighted coin thought experiment to really clarify this.
Okay, perfect. Imagine you find a betting game. The coin is weighted somehow to land on heads 60% of the time, and you bet $100 on heads.
Mathematically, that's a fantastic bet. The odds are in my favor.
It's a great bet. Now, you flip it once, and it comes up tails, you lose. Was taking that bet a bad decision?
Absolutely not. It was a good decision with an unlucky outcome. If I play that game 100 times, the math says I'm going to make money.
Exactly. Trading is just flipping that weighted coin over and over again. You will hit a streak of tails, 5, 6, 7, even 10 losses in a row.
That doesn't mean the coin is broken.
It doesn't mean your system is broken. It means you are experiencing normal, predicted statistical variance. The key is separating your ego from those outcomes. If you followed the process, the loss is just the cost of doing business.
The power of that math is perfectly illustrated by the story of Sarah, the options trader. Her win rate by most amateur standards was terrible.
Yeah, it was pretty bad. She only won about 40% of the time, lost more often than she won, yet she was consistently profitable.
So how does that work?
Her success was pure math. Her edge wasn't being right all the time. Her edge was in her quantified expectancy.
Expectancy. Define that for us.
Expectancy is the average amount you can expect to make for every dollar you risk on a given system. For Sarah, when she won, she made, on average, 3 times what she risked. A 1-to-3 risk-reward ratio.
Let's break down the math on that.
Oh.
Say she takes 100 trades and she's risking $100 on each one.
Okay, so 40 of those are wins. 40 times $300 profit. That's $12,000 in gross profit.
And the other 60 are losses. 60 times for $100 risk. That's 6,000 in gross losses.
So 12,000 in profit minus 6,000 in losses. Her net profit is $6,000.
And she achieved that while having what most people would call a losing psychology, being wrong 60% of the time.
And that's the challenge. Most traders, when they're down 3 out of 5 trades, they panic. They start to doubt everything.
So on their next trade, even if it starts working, they get scared.
They see it move just a little bit in their favor, maybe 1-to-1, and they snatch the profit. They can't stand the thought of it turning into another loser. But by doing that, they just sabotaged the 1-to-3 ratio. They destroyed the very math that made the system profitable in the first place.
Which brings us to that line between trading and gambling. If you're taking positions without a proven, testable edge and without strict risk management,
You're just gambling. By definition, the odds are stacked against you by commissions, spreads, and the market makers.
professional trading needs that proven, systematic edge executed with unwavering risk management. You know the single trade is uncertain.
But over a huge sample size, your quantified edge will play out. That's the definition of a professional operation.
Okay, so we need an edge, a systematic, testable, repeatable advantage. And the pro approach is specialization, right? Finding 1 or 2 small asymmetries and just exploiting them relentlessly.
Exactly. Instead of trying to be a master of everything, you become a master of one thing.
So what does a real quantifiable edge look like in practice? Not some guru saying buy low, sell high.
No. It looks boring. It looks specific. And it's mathematical. The material gives us some great examples of edges that focus on structural market behavior.
Let's take the first one. The trader who focuses exclusively on gap fills in, say, S&P 500 stocks.
Right. So this exploits a well-documented statistical tendency. When a big liquid stock opens way higher or lower than its previous day's close, that creates a gap on the chart.
And there's a tendency, under certain conditions, for the price to drift back and fill that gap.
Exactly. It's not magic. The professional has backtested thousands of these. They've identified the optimal entry and exit criteria, the volume patterns to look for, and now they just sit and wait for that specific setup to appear. Often they're done for the day in the first 90 minutes of trading.
That's fascinating because it means they are trading the reaction to the news, not trying to predict the news itself.
They don't care about the news. They care about the statistical pattern.
Or what about the trader who specializes in volatility crush around earnings announcements?
That is a prime example of exploiting a behavioral and structural distortion in the market.
Okay, what does that mean?
Well, in the options market, leading up to a big event like an earnings report, uncertainty is super high. So the price of options, their implied volatility, or IV, gets really inflated.
The market is pricing in a huge potential move.
Right. But once the news actually drops, whether it's good or bad, the uncertainty is gone. It's resolved. And that high implied volatility just collapses. It gets crushed.
So the professional structures a trade, often a short volatility position, to profit specifically from that collapse in IV.
Exactly. Regardless of whether the stock goes up or down a bit, they are betting on the market being less volatile after the event than it was before. It's a systematic, predictable edge that happens 4 times a year for thousands of stocks.
And the third example, time-based patterns, where a trader might only execute trades during, say, the first hour of the market on Tuesdays and Fridays.
They've done the work. They've realized that the market environment, the players, the liquidity, it all changes throughout the day. So they focus their energy only on the little window where their edge is statistically the highest.
That deep specialization is what really separates them.
Which brings us to understanding the context. You have to know who else is in the market with you. It's a massive, continuous auction, but not everyone is playing the same game you are.
We're talking about the different classes of capital, right? You have your big institutional investors, pension funds, mutual funds.
Yep. Then you have hedge funds who are often much more aggressive. You have market makers who are just trying to provide liquidity, high-frequency trading firms, or HFTs who are in and out in milliseconds.
And of course, us, the retail traders.
And crucially, we all have different goals. An institutional fund that's trying to buy 10 million shares of Apple over 3 months to build a long-term position, they do not care if the price dips 2% today.
Their goal is slow, gradual accumulation.
Right. A market maker has no directional opinion at all. They just want to capture the bid-ask spread. So if I, as a retail swing trader, see a stock grinding lower, I have to ask myself, Is this a real directional move, or is this just some big institution slowly accumulating, masking their buying? Context is everything.
And the behavior of all these players is driven by one core concept: liquidity. This is the real driver of price, at least in the short term.
It's the most important concept that retail traders ignore.
So define it for us again in a really practical sense.
Liquidity is just the availability of arresting buy and sell orders at the current prices. High liquidity means tons of orders are waiting, which slows price movement down. It's like driving through dense city traffic.
And low liquidity.
Very few orders are waiting, so a single large buy or sell order can just shoot the price through a level instantly. There's nothing here to absorb it.
The market just moves from one liquidity zone to the next.
It's an auction, constantly seeking the next block of orders. It moves slow through the thick areas and fast through the thin areas.
And ignoring liquidity is how you get wiped out by slippage. Which brings us to that anecdote of the mid-cap options disaster.
Oh, that story is just a horrifying lesson in liquidity risk. This trader had a great system, a great edge, but he applied it to options on a mid-cap stock.
So a less liquid instrument than something like the SPY or Apple.
Way less liquid. He was profitable for a while, but then some unexpected major news hit the stock. He entered his stop-loss order immediately, as he should. But because of the news, everyone was rushing for the exit at the same time.
So the spread between the bid and the ask just blew out.
It widened instantly. He had his stop price set, but when the order hit the market, there was simply no one left willing to buy at that price, or even close to it.
So his order just kept slipping down looking for a buyer.
Correct. The trade finally executed at the next available price, which, because of the panic and the total lack of liquidity, was 28% below his intended stop level.
Wow.
What should have been a small, controlled 1% loss turned into a massive, account-damaging catastrophe.
Pro tip established. You have to trade liquid instruments. Or, if you don't, you have to size your positions so small that your order doesn't move the price.
And you have to understand that a stop loss is a market order. And in a fast, illiquid market, a market order just means get me out at any cost.
Which leads us into how pros use this knowledge to read price action. They look at support and resistance, SR, not as these magic lines on a chart.
Amateurs see magic lines. Professionals see history. They see SR as historical price levels where a big cluster of orders and order flow imbalance happened before. The strength of that level is defined by the volume that traded there in the past.
So as price approaches that level again, they're analyzing the conversation between the buyers and sellers.
That's a great way to put it. Are aggressive sellers just smashing market orders against the bid, creating these sharp, high-volume down moves? Or is the price slowly grinding higher on these small, passive candles?
Which would indicate patient accumulation by buyers.
It tells you who's urgent and who has conviction. And the most critical validation tool here is volume. A technical breakout above resistance means nothing without volume.
It's the fingerprint of institutional conviction.
That's it. A breakout on massive, confirming volume is a sign that new big money is entering the game. That suggests strength and follow-through. A breakout on low volume is often just a handful of smaller traders pushing the price around.
Which makes it highly vulnerable to reversal.
A trap.
A classic trap. Which leads directly to the idea of the failed move, or what some people call a stop hunt.
This is where the price will push just past a known key level, like the low of the previous day.
A level where everyone knows there are a ton of retail stop-loss orders clustered. The large participants know exactly where those stops are, and they can push the price through that level just to trigger them and grab that liquidity.
So they get the shares they need from all the retail traders getting stopped out. Exactly. And once those stops are triggered, they reverse the price instantly, trapping all the novice breakout traders who just went short. Reading that immediate sharp reversal, that failed move, is often the professional's signal to take the opposite trade.
Okay, so if the last segment was about finding the edge, this one has to be about surviving long enough for that edge to even matter.
Yes. We absolutely cannot overstate this.
The hierarchy of professional trading is risk management, first, second, and third. Everything else, your entry, your indicators, your stock picks, it's all secondary.
It is truly about survival. It's like being a pro athlete. Your first job is to not get injured and end up on the bench. As a trader, you have to make sure you don't sustain a catastrophic drawdown that takes you out of the game entirely.
Amateurs focus on the reward first. How much can I make?
And pros obsess over the risk. What's the absolute most I can lose here?
That brings us back to Mike, the trader with the great system but these wild, volatile results. He could make 30% in a month.
And then lose 40% the next. Mike's decent strategy was completely ruined by his inconsistent risk management.
So he'd risk, what, 1% most of the time?
Yeah, but then he'd get a hot tip or he'd be really sure about a setup, and he'd bet 5, 10, even 20% of his entire account on one trade.
And when those big bets inevitably failed.
They wiped out months of his disciplined work in a single afternoon.
So the ultimate solution, the bedrock of professional trading, is the 1% rule.
Never risk more than 1% of your total account value on any single trade. And this isn't a suggestion. It is mathematical reality, and it is built for survival.
Okay, let's look at the actual math, because this is where the amateur mind really struggles.
Yeah.
Let's contrast the 1% risk versus Mike's 10% risk during a losing streak.
Okay. If you risk 1% per trade and you have 10 consecutive losses, which will happen even to the best systems, you're down about 9.5% of your account.
Which is painful psychologically.
Yeah.
But it's totally recoverable.
It's recoverable. You need roughly a 10.5% gain to get back to break even. Now let's look at the 10% risk scenario.
10 losses in a row, risking 10% each time.
You are down nearly 65% of your account. That's because the 10% is calculated on a smaller and smaller balance, and a 65% loss is catastrophic.
Because to recover from that,
You don't need a 65% gain. You need a massive 186% gain just to get back to where you started. It's almost impossible. That's why pros stick to that tiny risk parameter. It keeps you alive long enough for your statistical edge to actually play out.
so once we accept that dollar risk limit, the 1%, we can move to the core technical skill, position sizing.
This is the formula. This is the mechanism that guarantees you stick to that 1% rule, no matter how volatile the stock is or how far away your stop is.
Okay, so it's a 3-step process.
It is. First, you define your max dollar risk, 1% of your account. Second, you look at the chart and determine where your stop loss needs to be. Third, you use the formula to calculate how many shares to buy.
Let's use an example. A $50,000 account. My max risk is 1% or $500.
Perfect. Now, the formula is simple. Position size equals your max dollar risk divided by the distance to your stop loss.
So I look at the chart, I find a key technical level. The chart tells me the stop for this setup has to be placed $2 away from my entry price.
Okay, so you plug that in. $500 of risk divided by a $2 stop distance, that equals 250 shares.
That's my position size.
That's it. And here's the crucial realization that separates the pros. That position size must adjust based on the stop distance.
Right. So if the next trade is riskier, more volatile, and the logical stop is, say, $5 away.
Your position size drops to 100 shares, 500 divided by 5. If the stop is super tight, maybe 50 cents away, you can take a 1,000-share position.
In all 3 cases, the dollar amount I'm risking is the exact same, $500.
Your risk is constant. The chart dictates the position size, not the other way around, which feeds right into stop placement.
Stops are not random.
Yeah.
Amateurs will just say, oh, I'll put my stop 5% below my entry. That's arbitrary.
It's mathematically unsound. The professional places the stop at the exact price level where their entire technical thesis for the trade is proven definitively wrong.
So for a long trade, that might be just below a key support level or a previous day's low.
Exactly. You find that level because if the price hits it, your reason for being in the trade is gone. It's invalidated. You have to get out with a small loss. You determine that distance, and then you calculate the position size to keep your risk at 1%.
And the iron rule, once that stop is set, it's sacred. You leave it alone.
Moving your stop further away is just hope overriding math. It's the single most common cause of a catastrophic loss. When the price is heading for your stop, your emotional brain is screaming, just give it a little more room.
But the pro understands that moving the stop violates the entire risk calculation.
They only move stops in one direction, tightening them toward the entry or moving them past the entry to lock in profits. We call those trailing stops, but you never ever give it more room.
Let's tie this all back to profitability with risk-reward ratios, or RR, and why win rate isn't everything.
The RR ratio is what quantifies your potential edge. Risking $1 to make 3 is a 1-to-3 ratio. And we already saw with Sarah's story that a high RR can make a low win rate system very profitable.
Let's look at the opposite scenario that traps so many amateurs, the high win rate trader. They chase that psychological hit of being right 70% of the time.
And to do that, they have to take quick, small profits. So they might risk $1 to only make 50 cents. A 1 to 0.5 RR.
So if that trader takes 100 trades,
70 wins times $50 profit is $3,500. 30 losses times a $100 loss is $3,000. His net profit is only 500
That
bucks.
margin is razor thin.
It can be completely wiped out by commissions, a little bit of slippage, a couple of bad decisions. It's not a robust system.
So the professional, understanding this mathematical leverage, consistently targets 1 to 2 or 1 to 3 trades. They focus on expectancy, on that high average return per trade, knowing full well they're going to be wrong a lot.
And they accept that being right 70% of the time often forces you to cut your winners short, which destroys your RR and ultimately your long-term profitability.
All right, so we've got the mindset thinking and probabilities, and we have the survival mechanism, strict risk management. Now we have to turn this into a predictable, repeatable operation.
Right. We have to move beyond just having an edge and build a complete system.
A system is the codified business plan. It's the set of unambiguous rules that governs every single aspect of your trading, not just buy when this line crosses that line.
Exactly. You mentioned Rachel, the swing trader. She had great ideas for entries, but because she had no rules for anything else, she was constantly improvising.
And getting inconsistent, choppy results.
Of course, because her decision-making was being driven by emotion in the heat of the moment. A system is what removes that emotion.
So what are the components of a complete system? What's in that business plan?
It systematizes the entire journey. Market selection, what instruments do I trade? Environment filters, for example. I only take long trades if the S&P 500 is above its 200-day moving average.
Then the specific setup criteria. What chart pattern am I looking for? The entry trigger. The exact price or time to pull the trigger.
Your stop rules, your position sizing math we just discussed, your trade management rules. Do I add to the position? Do I move the stop?
Yeah.
And crucially, your exit criteria. When and how do I take profit?
The commitment here is not just creating this system, but then actually executing it flawlessly.
That's where the discipline comes in. The difference between a good plan and good execution is everything. You have to commit to executing that system perfectly for a minimum of, say, 100 trades.
100 trades. Why that number?
It's a statistically significant sample size because a losing streak of 6 or 7 trades, which feels like the end of the world emotionally, is statistically normal. If you change the system after 7 losses, you might be abandoning it right before it's about to go on a winning streak. Any changes have to be driven by data from that 100 trade sample, not by fear.
Okay, let's talk about the tools. What do pros actually use versus the myth of the complex, proprietary, expensive software?
The reality is almost disappointingly simple. Think back to Tom, the trader who'd been profitable for over a decade. He used 2 monitors, clean price bars, and volume.
That was it.
That was pretty much it. He made a great point. Almost every complex indicator, MED, RSI, stochastics, they're all just mathematical derivatives of price and volume. If you can learn to read the primary source, you don't really need the derivative.
So they're prioritizing clarity. What tools do they generally ignore?
They ignore the highly subjective or arcane stuff. Things like Gauss squares, intricate Elliott wave counts that, 5 different people can interpret 5 different ways, and redundant oscillators. If an indicator is just telling you the same thing as the one you already have, it's just clutter on your screen.
So what are the essential non-negotiable tools then?
Clean price charts. Volume is a must. The simple moving averages, the 20, 50, and 200, are great for context and dynamic support and resistance. And the average true range, or ATR.
The ATR is a big one. Why is that so important?
Because it measures the current volatility of the instrument. It tells you what a normal price move is right now. That allows you to place your stops logically outside of that normal noise and calculate your position size accurately based on the current market environment.
And the single most crucial tool for the business side of things
Is the detailed trading journal. If you are trading without a journal, you are operating blindly. You're just guessing.
The journal is where you gather the data to prove or disprove your edge.
And it has to track more than just your P&L. You need a screenshot of the setup, your actual entry and exit prices, the specific reasons for the trade, the time of day, and crucially, your emotional state when you entered and exited.
And an execution score. Did I follow my rules? Yes or no?
Exactly. That data is gold. It's what allows you to find your flaws and improve.
Let's get into advanced execution. Getting in and out, there's always this entry dilemma, this trade-off.
There is. You always face the choice between an early entry.
Which gives you a better risk-reward ratio because you're getting in sooner.
Right. But it also increases your chance of getting stopped out because the move isn't fully confirmed yet. versus a late entry, which gives you more confirmation, but your RR is worse because the price has already moved halfway to your target.
So what do pros do?
They tailor their system to prefer one or the other, or they might use both for different types of setups. There's no single right answer. You just have to define it in your plan.
And the choice of order type, market versus limit.
Pros use market orders when speed is everything and liquidity is high. If they see an urgent setup in the S&P futures, they need to get in now. They use limit orders when price control is more important, in slower swing trades, or in stocks with wide spreads where they don't want to give up their edge to slippage.
Finally, the exit strategies. This is where the money is really made or lost.
You can have the best entry in the world, but if you have a bad exit strategy, the whole system falls apart.
So we have fixed targets, trailing stops, or the pro standard, the hybrid exit.
A pro rarely relies on just one. A fixed target, like selling at 3-to-1, is simple and it locks in gains. But you can miss those huge home run trades.
And a trailing stop lets your winners run, but you often give back a chunk of your profit on a minor reversal.
So the hybrid exit combines the best of both. The pro will use a hard stop for protection, but they'll take partial profits, maybe sell half their position at a fixed target like 2-to-1.
That locks in some guaranteed money and basically pays for the trade.
It covers your initial risk. Then they let the remaining half of the position run using a tight trailing stop. This is the balancing act that lets them stay consistent while still being able to capture those massive market moves when they happen.
We've built the fortress of the system. But we all know systems don't fail. People fail the systems. This means discipline is fundamentally about fighting your own impulses, especially when your account balance is jumping all over the place.
Discipline is the conscious choice to trust the rules created by your rational self. You know, the you that calmly back-tested the system on a Tuesday afternoon over the impulses generated by your emotional self. The you that's trading in the middle of a Friday afternoon sell-off.
I like how Kevin put it. My biggest competitor isn't other traders. It's my own emotions.
It's so true. And the failure points are predictable because they're driven by these primitive biological reactions.
So what does disciplined failure actually look like?
It looks like taking trades that don't meet your system's criteria because you're bored. It's exiting a perfectly good trade just because of stress. It's sizing your position based on how confident you feel, not on the math.
Overtrading, just for the need for action.
And the single most destructive one, revenge trading. Trying to instantly win back the money from a loss you just took.
When a trade starts going against you, what's actually happening inside the brain?
Your amygdala, the part of the brain that handles threat detection, it activates. It doesn't know that a flashing red number on a screen is just a number. It registers a threat to your resources, to your survival.
And it triggers a fight or flight response.
Exactly. It floods your system with cortisol and adrenaline. And that physical chemical reaction compels you to act immediately, move your stop, cut your winner short, anything to just alleviate that stress. Discipline is the deliberate, repetitive practice of overriding that primitive impulse.
This is why handling losses has to be seen as a mathematical event. Losses are not failures. They are the unavoidable, necessary business expense of a probabilistic game.
They're the rent you pay to stay in the market. You have to be philosophical about it. We already showed that even a great system will statistically have losing streaks of 5 or more trades.
So when you're down 5 trades in a row, the amateur thinks, my system is broken.
And the professional looks at their spreadsheet and says, is this statistically normal?
So what's the professional's antidote to that losing streak stress?
First, a statistical check. Is this losing streak mathematically normal for my system? If my system's worst historical drawdown was 7 losses in a row, then 5 is unpleasant, but it's normal.
Okay.
Second, tighten execution. Am I making small errors? Am I getting sloppy? Third, review market conditions. Has the market environment changed? Maybe my breakout system doesn't work well when things get choppy. Only if the sample size is huge, 100+ trades, and the metrics are really deviating, do they even consider changing the system?
They never abandon the system during a drawdown.
Because they'll miss the inevitable recovery period.
Let's talk about some specific psychological traps that pros actively fight against. First, the certainty illusion.
The brain hates uncertainty. It's scary and it takes a lot of energy to process, so it manufactures false certainty. This trade has to work.
And that's dangerous because certainty makes you complacent about your risk.
It does. Professionals counteract this by actually verbalizing the uncertainty. I know a trader, Catherine, who literally says out loud before she enters a trade, I don't know what will happen next. This could easily be a loser.
That verbalization forces the rational part of her brain back into control.
It reminds her that it's just a probability game.
And second, the ever-present outcome bias, which we talked about earlier.
This requires constant self-policing. When you win big, your brain says, "You're a genius. That was a perfect decision." When you lose, it says, "The system is broken. The market cheated me."
You fight this by tying your self-worth only to your process compliance.
If you followed your rules, you succeeded, period, regardless of the outcome. This dramatically reduces the emotional roller coaster of watching your P&L fluctuate.
And the final psychological challenge is maintaining that confidence-humility balance.
This is a tough one. You need confidence to pull the trigger when your setup appears. That's confidence in your process. But you need profound humility to respect the market and respect risk. That's humility about market outcomes.
And that humility is most critical during the winning streak trap.
Winning streaks are so dangerous, they inflate confidence into arrogance, and arrogance leads to discipline creep.
You start relaxing your rules, taking trades that are only 80% qualified.
And most fatally, you start increasing your position size way beyond the 1% rule because you think, I can't lose right now. The huge loss that almost always follows a long winning streak is due to this arrogance. It wipes out weeks of disciplined gains.
A professional stays humble. They stick to their systematic size. They recognize that some wins are just good luck, not superior skill.
Always.
Okay, let's bring it all home. The ultimate definition. Professional trading is a systematic business operation. It is the CEO mindset applied to capital allocation.
As Robert, the seasoned trader, advised, treat it like a business from day one. A hobby is something you do when you feel like it. A business has structure, routine, and accountability.
This means establishing that essential business infrastructure. It starts with the comprehensive written trading plan. That's your operational manual.
And the record keeping. It has to be exhaustive. Your journal provides the data for you, the CEO, to make informed decisions.
And it has to go beyond P&L. You need to track your emotional state, the market conditions, was it trending or range-bound, and the quality of your setup.
Absolutely. Was it an A+, a B, or a C setup? If you find out you're making all your money on B setups but losing on your A+ setups, that's something you need to investigate.
This record keeping feeds directly into performance analysis. You can't fix what you can't see, and your emotional memory will always lie to you.
Data is truth.
What are the key performance indicators, the KPIs, that pros focus on beyond just simple profit?
The most important metric is expectancy, the average R multiple you make per trade. If your expectancy is 0.5, it means that every time you take a trade, you statistically expect to make 50 cents for every dollar you risk. You want that number to be as high as possible.
And the profit factor. This is a great one for measuring the efficiency of your system.
Profit factor is simply your total gross dollars won divided by your total gross dollars lost. If your system makes 15,000 on winners and loses 10,000 on losers, your profit factor is 1.5.
Anything above 1 means you're profitable.
Right, but pros are aiming for 1.5 or higher. That shows you have a robust system that generates substantial profit for every dollar you put at risk.
Other KPIs would be your win rate, your average win versus your average loss, and your maximum drawdown.
Knowing your historical max drawdown is vital. It tells you how much capital you need to survive the next inevitable storm. And these KPIs, they fuel the essential review cycle.
This isn't just glancing at your P&L at the end of the week.
No. Pros run structured reviews, weekly, monthly, and quarterly. The weekly review is about execution quality. Did I stick to the plan? Did I make emotional errors?
The monthly review is about psychological patterns and the market environment.
Right. And the quarterly review is about edge deterioration. Is my expectancy or my profit factor starting to drop? Has my specific setup stopped working as well? Has the market structure changed?
Now let's tackle the final hurdle, scaling. This is where you actually build wealth, but it's the ultimate psychological challenge.
It is the moment where the 1% rule breaks the average person's brain. The math says 1% risk is fine, but when your account grows from $50,000 to $500,000, that 1% risk jumps from $500 to $5,000 per trade.
And even though the percentage is the same, seeing a $5,000 loss pop up on your screen is emotionally paralyzing.
It leads to what we call sizing paralysis. The trader starts cutting winners at half an R because they can't stand to see that $2,500 profit disappear, and they violate their stops because they can't psychologically accept a $5,000 loss.
They destroy their own system because of the emotional weight of the bigger numbers.
Exactly.
So what's the professional solution? How do you get used to that?
The first approach is gradual scaling. You don't jump from risking 500 to 5,000 overnight. You increase your position size by maybe 10 or 20% at a time. It lets your brain normalize the increased dollar exposure.
And the second approach, which Kevin used, is temporary size reduction.
Yeah, this is brilliant. When he hit a new equity high, he would temporarily drop his risk from 1% down to 0.5% until the emotional weight of that new dollar size felt normal.
So once a $5,000 loss felt as emotionally mundane as a $500 loss used to.
Then he would increase his risk percentage back to 1%. It proves that your psychology dictates the pace of your growth, not the market opportunities.
Which brings us to the final message. The realistic journey ahead. This is not a get-rich-quick scheme.
Not at all. It takes 2 to 5 years to achieve true, consistent profitability.
And the path is defined by managing drawdowns, repetitive execution, and slowly compounding returns. Is profoundly unglamorous.
Success in professional trading looks like systematic, boring execution. It's quiet wealth accumulation, and it's the resilience to weather those inevitable, boring losing streaks. The difference between those who make it and those who don't is simply the willingness to do the boring, systematic, disciplined work.
The market is ready to offer its rewards, but only to those who survive long enough to claim them. So the question for you is, are your rules in place right now to ensure that you survive the next inevitable losing streak?
Think about the math, not the emotion.
If you want more of this kind of videos, hit that subscribe button now. Thank you.